Welcome to the Heart of It All, presented by RBC Wealth Management. It is part 2 of our finance episode with finance guy Rob Carrick. We are going to unpack some things that you may not want to learn about, but you really do have to, guys. We all got to get on board. It is an invaluable episode with one of the strongest minds about finance that we have in this country, Rob Carrick, coming up on the pod. Welcome to the Heart of It All. I'm Teri Hart. We are into part 2 of our finance episodes with Rob Carrick. And I have to tell you, these are the episodes that I have been so excited for. I am so passionate about financial literacy, but I wanted to make sure that we had the exact right person here to educate us all at once. And that right person is Rob Carrick. Caring for your parents or eventually yourself isn't just an emotional journey. It can quietly reshape your entire financial life. Health, family dynamics, cognitive changes, it all connects and it all matters. RBC Wealth Management wants you to feel like you actually have a handle on this, not just financially, but as a whole person navigating a whole life. Because confidence isn't just about having money. It's about knowing what comes next and having a plan for the longer run. It's one reason they've partnered with experts in caregiving and wellness, including cognitive health. Because the earlier you have these conversations, the better. Having the right people in place at the right time matters for both your wealth and your health. Last week, we had Rob's financial checklist for those of us with aging parents. And this week, he and I break down TFSAs, RRSPs that turn into RRIFs, a HELOC, a home equity line of credit, and reverse mortgages. These are all things that could impact how we live, will certainly impact estates, and they are things that we need to know in our lives, not just for our seniors, but also for us. Buckle up. It's part 2 with finance guy Rob Carrick. Last week, Rob Carrick walked us through his 7 steps of a financial checklist for people with aging parents. If you haven't listened, go back and listen to that. That advice is going to save you so much time, so much energy, and get you where you need to get with your parents so much quicker than anything you've ever heard on this podcast before. This week, we are going to talk about some other practicalities that people face as they age. Maybe they want to age in place. Maybe they're completely prepared to go to a retirement community. As we've said, the finances matter, and there are options for those things. For many who are wanting to age in place, come what may, they need to find some extra money for home care, as we've talked about, or caring for the home that they're in, or making renovations for the home that they are in. What are their options? Are seniors like good candidates for loans?
I would think a loan would not be ideal because you're going to have to make payments. And if you're going to get a significant chunk of capital to make a big change in your home, to retrofit your home, or to create a budget for affording, home care, you're going to need a lot. Interest rates today in or let's say, April 2026 are not particularly favorable for borrowers. And so I don't think a loan is something you want to do. I would see 2 options, and this assumes you're not downsizing and selling. You're staying in the home. You own your home outright. You've made lots of equity over the years, but you can't tap it easily unless you do 2 things. One, a home equity line of credit. And my recommendation to people is before you retire, if you don't already have a home equity line of credit, get one. Cost a few $100s to set up, most likely. And people say, Rob, are you encouraging me to borrow? No, I'm encouraging you to have a borrowing tool in your back pocket in case you need it. And what a home equity line of credit allows you to borrow against the home equity in your home. You get a preferable interest rate because the bank or the lender knows, well, we can always sell the house if we have to. That very unlikely to happen, but they feel comfortable because the house secures the line of credit, and you basically can tap into it as you need. You can go online and say, I need $10,000. Click, click, click. It goes from your home equity line of credit into your checking account, and then you can spend that money. And you do have to make monthly payments with a home equity line of credit or a HELOC, but it's just the interest. With a loan, you're paying a mix of principal and interest. Here, you're just paying interest, and it might be manageable for you. And you can just keep punting that down into the future, paying your monthly interest, and you have a certain amount you took out of the home equity, like, and you think, oh, I need 10,000 more. Okay, a couple of clicks of the mouse, you've got the extra money. Now your minimum monthly payments will go up if you borrowed more because there's more interest owing. But you have a lot of control. And if you think, oh, I've got maybe I took some money out of my TFSA, I'm going to pay down the home equity line of credit debt. Click, click, click. You just add it from your checking account back into your home equity line of credit, and you can pay it down anytime you like.
Okay. So that's a HELOC, a home equity line of credit. We see advertisements all the time for reverse mortgages. Is that the same as a HELOC?
No, a reverse mortgage is quite a bit different. With a reverse mortgage, what you're basically doing is you're borrowing against the value of your home, and you can borrow up to a certain percentage of your home equity. I forget what it is, and it may differ from the various providers of reverse mortgages. And you don't pay any interest or any principal until the home is sold. So in the background, the interest is applying, and the amount of interest you owe is going up, up, up every month, every year. But you don't pay it back until you sell the home. And that's quite appealing to people because they think, well, I need money and I can't really afford to make big monthly payments on it. Well, that's where reverse mortgage comes in. But the issue, though, is that when you sell the home, you get a price that you sold it for less what you owe the reverse mortgage company. And so people sometimes think my home's worth $1 million and I'll pay the real estate commission and I keep all the rest. But if you have a reverse mortgage, it could be hundreds of thousands of dollars you owe the reverse mortgage company because they gave you this big lump of money up front and you're paying them back when you sell the house. And that may or may not be an issue.
Okay, so I have a theory. Do you want to hear my theory, Rob?
Sure, go ahead.
All right. So you know how we hear that there's trillions of dollars that the boomers are going to pass on in the next however many years to
Yeah.
the Gen X and millennials, and there's all this money that's going the big transfer of wealth.
Yeah.
I think that that big transfer of wealth is going to be impacted significantly because of people wanting to live bigger lives than they anticipated in their retirement. They're living longer than they anticipated. They're wanting to age in place. And how they are getting that financial possibility is through reverse mortgages. And that big transfer of wealth maybe isn't going to be the same as a lot of people think it's going to be. Do you think I'm crazy?
No, I agree with you 100%. I've said the same thing before. I think the wealth transfer is based on the idea that there's going to be all this extra money left over. And for many affluent people, there will be plenty. There will be lots of money left over, and they will transfer it down to their kids, and it will make a meaningful difference in their kids' lives. But this pool of money that boomers have accumulated, um, yes, there will be surpluses, but in a lot of households, for all the reasons we've talked about in the previous episode, a lot of money will get soaked up by care costs. And as you're rightly pointing out, boomers have a different take on retirement than the silent generation that preceded them. Like there's a much more enjoy yourself, like enjoy the finer things, take that trip, fly first class, go an extra week, have a second or third vacation every year. And I think that will lead into money. But the care costs that is the one that nobody really understands because it's only occurring so late in individuals' lives. And then everybody's scrambling to get all the details and they're making it up as they go along. And people aren't planning to say, I think I'll have this much money in surplus and I'm going to give it all to my kids and I'm going to give it to them in the next year or two so they can buy a home and they can use it as a home down payment. And they're not factoring in the considerable funds they may need for home care or for the kind of retirement home they would like to go into, that sort of thing.
And people are living way longer than we've ever anticipated in society. And there is, but what I like to say, Rob, is people are living longer, but it's not without consequence. There is a large gap between lifespan and health span. We talk about that a lot here on the podcast. And so I don't, people are imagining, well, this is how much my life costs me now at 75 or 78. Well, it's going to be different when you're 90. Even if you're still living in your home, it's going to be different.
The gap between the lifespan and the health span is your span of which you're a healthy, mobile kind of person, is a very poorly understood concept. And people just don't understand that as when the health span sort of tops out and the lifespan keeps rising, that gap is an expensive gap. And you probably will have to pay expenses every week or month to get by and get through it. Living longer, like it's eye opening all the parts of the body that can break down and that you're going to need help managing that. And certain other parts are going strong, but the parts that break down, they need to be you need backup, and money's how you do that.
I was really struck by something I read in one of your articles. Maybe it was on your Substack, Rob, by the idea of how much money you need to save versus how much money you need to live. Why is that
Yeah.
an important distinction? And is that falling into the category of the health span versus the lifespan?
Well, how much you need to save is almost an unknowable number. I mean, because it's so abstract. How much you need to save? I mean, how many years are you gonna live? What lifestyle would you like to live? I mean, those are all variables that go into how much you need to save. I prefer to look at what will you spend? And then you can say, do I have enough income or enough savings to fund that for the lifespan I expect to live? And like most financial planners will probably say, we're gonna map out your finances till 90 or 95. And some may be even extreme and go to 100. Um, so in the financial planning profession, they are grappling with these longer lifespans. So the issue though is how much am I going to be spending every year, and will that stay the same? Of course, it won't. There used to be a financial planner I talked to often, and he said there were the go-go years of retirement, the slow-go years of retirement, and the no-go years, meaning that your spending would taper down steadily. But I think in the years that have gone by recently, and as it's become more normal to live to your late 80s or early 90s, the no-go years aren't cheap years. That's what we're learning. They're expensive years. And so what you might have been spending on trips and activities and memberships and subscriptions and tickets to events might now go to care workers and for retrofitting your home and that sort of thing, or for that nice retirement home you want to go to. And so it might be almost a U shape where you spend a lot at the top, and then you have these years when maybe you're cutting your travel and you're cutting your activities, and all of a sudden you're not doing anything, but the cost of supporting you get very high. And so I think mapping out what you're going to need, and that cost of aging calculator we talked about in the previous episode can help you map out what your costs might be in your later years. That's really the thing. So you could say, I think we could live on a budget of let's say $100,000 a year, doc, my spouse and I, and I've costed out, cost of, entertainment and home insurance and all of the various costs of life. Um, and then, you might want to ramp that up over the years for inflation. And then to sort of say higher healthcare costs and support costs in my later years, I need to be able to afford that too. And that will all dictate how much money you need to have in savings, how much I plan to spend per year, and how many years I'm going to live. And then a financial planner can help you say, okay, but I'm going to be growing my investments every year, and I'm going to get an inflation increase for Canada Pension Plan and an OAS. How does it all work out? And 500,000 might be enough for that sort of thing, or it might be a million, it might be 2 million, 3 million. It depends on you and how you are planning to spend, is how long you think you might live. And I mean, to estimate that, what kind of health are you? What's your health level? Are you healthy, fit? Have you had any medical challenges? What about your parents? What was their longevity? What did you do for a living? Like how does your body feel? You can sort of make an educated guess about how long you're going to live. And so those are the real Those are the real considerations. Like, I have seen financial companies put out these polls asking people, how much do you think you need to retire? And the headline will be, people think they need 1.7 million.
That's the
Well,
number.
that's
That's the number
nonsense.
I see all the time. I think it was
Yeah,
just a headline I saw today. It's 1.7 million. And it never says, is that for one person? Is that for a family? Is that for like all of those criteria that you talk about? They don't seem to be able to give us. And people want to have something to hold on to, right? And yeah,
right.
this 1.7 million seems, I don't know.
It's like asking how many grains of sand should be on the beach. You know what? It's everyone's just going to make up a number, and it has no bearing on their reality or anyone else's.
Okay. So I think we've done a pretty good job of talking about HELOCs, reverse mortgages, and the difference being how you pay it back. The HELOC turns into a monthly payment paying for the interest, whereas the reverse mortgage, you take it out, it is accumulating interest that you will owe when you pay off the house. So the principal
That's
and the interest is being accumulated and you're not looking at it. So if you stay living in that house for 10 years and you're paying 8% or 9% or more on that reverse mortgage, that is going to eat into the equity of your home.
You just raised a very good point there, and that is you talked about, I think, 10 years there. That's a long time to have a reverse mortgage. You can carry them for decades, but that's a lot of erosion of home equity that's going to happen there when you eventually sell. I think reverse mortgages, they're growing quickly in Canada, but from a small base. They haven't really hit the big time.
Growing in
And
popularity?
right. Right, and I don't think they've hit the big time. None of the big banks offer them. They're offered by, very reputable, smaller financial companies, who are finding a ready market for it, but not a mass market. And I do find it kind of interesting because a lot of people are very rich in home equity, but they don't have great incomes. And the home equity line of credit is a great way to sort of reconcile those two realities. But I think they work best when you're in the home stretch of life. Let's just be blunt here. And you think, I would like to retrofit my house. I would like to be able to fund caregivers to come and support me in my house. Reverse mortgage, and you sort of see a few years of that. Reverse mortgages can be a very good option for that. I mean, people are a bit squeamish about them, because of this idea that of this sort of quiet erosion of home equity happening, under the surface. But you may think, I am totally willing to give up several $100,000 of home equity in order to stay in my home and have a great lifestyle.
Yeah.
And I think reverse mortgages will be used more and more. And I wouldn't be surprised eventually to see some bigger financial company get involved with them, because I just think they have to be considered as one of the tools to be used in an aging population for generating income, and money that you can use to spend on your life, on your healthcare, on your quality of life.
Yep. And that aging population who so overwhelmingly want to age in place, whether that be misinformed or not, that being the want is what I'm talking about here. Okay, so we are talking about the things that maybe are going to affect your overall estate. And one of the things that I think, I don't know if you agree with this or not, Rob, but I think is completely misunderstood is the lifespan of an RRSP, so a registered retirement savings plan, many Canadians have them. When you are 71 years old, your RRSP turns into a registered retirement investment fund. And what that means is in your 71st year, you are obligated to take a minimum out of that to essentially satisfy the tax burden of that investment vehicle to the government. Is what I'm saying correct?
Yeah, with the registered retirement income fund, there is a minimum you have to withdraw every year. Basically, the government's saying, we've let you accumulate investment gains in this account for decades, and now you're using it for retirement. We want to make sure that a certain amount of that comes into the taxable realm, and the government can tax it and use that to fund your healthcare and all that other stuff. So that is a reality. And some people think, well, I don't want to take that money out of my RIF. Now, that's a fortunate problem. A lot of people have to take money out of the RIF, and that's totally legitimate. That's why you have a RIF. Take money out, help you live, generate retirement income. But some people don't need to take the money out, don't want to. You still have to. I think that's kind of a luxury problem. It doesn't really concern me very much. You can take money out of your RIF and put it in a TFSA. You can take that money out and invest it. It's not like the government's gobbling up the whole amount. It's just you take out, you take out $10,000. The government will apply, your marginal tax rate against that when you're filing your taxes, and that becomes, the amount you took out of your RIF becomes part of your income, and you will pay tax on that. But you got a tax deduction when you made the contribution to your RSP in your working year. So it's just basically it's the symmetry of it. The government gave you the tax deduction, say, we really want you to contribute to your retirement through an RSP. We're going to give you a tax deduction. And when you take the money out, and it should have grown a ton over the decades, yes, we're going to tax that. And, that's how we'll reconcile the tax break and the withdrawal.
So yes. So all of that, I think people really need to understand that whatever is sitting in you or your RIF or your loved one's RIF, if you are responsible, if you have done number one and you have a joint bank account with your aging parent, as we went through last episode, then you probably know what is in their RIF. When your loved one dies, whatever is the balance in that RIF, if they don't have a spouse for that RIF to go to, counts 100% as income for that year. So if you have $300,000 sitting in your registered retirement income fund, that counts in the year of your death that you made $300,000 that year, and it will be taxed at the highest tax rate in Canada, which I believe is 53.4%. Correct?
Right. Yes, that is correct. And a lot of people, I mean, I guess a lot of families are surprised, oh, my parent died with a sizable RIF and there's a tax hit on that. And so they might have imagined that there was a legacy of a certain amount, but it's going to be considerably slashed by the tax bill. And that what that does is argue for estate planning. That's how do we get the money out of the RIF in a way that satisfies the RIF owner's need for income and safety to make sure it lasts and it's sustainable, but also that we don't end up hoarding the money in the RIF so that there's this giant block of money and the government just slices it in half on death.
Okay. So I'm so passionate. I think you can probably tell in my voice. I'm so passionate that people understand this, because I do fear that people do not understand it. And then there's a lot of ideas around what will happen, and then those things aren't able to happen. And I think it's very difficult for people to face a reality that they weren't aware of in terms of estate planning. Knowing that, is a TFSA a better investment
Well,
vehicle?
I think you know what the thing is. People seem to like really want to know, is TFSAs better than RIFs? I think you're going to need both. I mean, TFSAs just you can't save enough in TFSAs for retirement, and people will be accessing money in their TFSAs all their lives most likely. A TFSA is a multi-purpose savings tool. You might have a TFSA that's for retirement, and you might have one for other purposes. So to say that if I just top up my TFSA, that's a much better tool than an RSP. You're going to need both. Um, I think that each one has certain benefits. I think RSPs get a raw deal. I think they are very, very good tools for accumulating capital and for reducing your tax bill in the years you make contributions. And there's a few financial planning tricks you can do with RRSPs. For instance, you can buy a spousal RSP. So I think there's good reasons to use them. Um, but I think the trick is to have a very well-rounded retirement savings portfolio. You have your TFSAs, your RSPs, and if you're really fortunate, you'll have a company pension plan, and you may even have some non-registered investments. And then you need to think, how do I exploit these when I'm retired? Which am I drawing from first? Where's the money going to come from? Let's say you have CPP and OAS and you have a small company pension plan, but it's not really enough to make a big difference. I'm going to need to tap into some of my savings. Do I draw from my TFSAs first or my RSPs first or my RIFs? What do I do? And I think that's where a financial planner can sort of help you, give you a plan. We're going to tap this first, then we're going to do this, or we'll take a little bit from each. And the idea being that by the time we get to a certain age, there's not going to be much left in your RIF, but you'll still have money in other places in case you need it.
Okay. Should this is I don't know if you can answer this because you're a finance guy, you're not a therapist, but I'm gonna ask you anyway, because sometimes being a finance guy, there's a Venn diagram between finance guy and therapist.
Yes. Yes.
So, should people be talking about inheritance and the implications of inheritance when it comes to lifestyle choices? Like, when we're talking about that reverse mortgage that lets mom or dad stay in their home, but means there's going to be half the equity in the house.
It's really tricky what you're talking about here because I know there's a lot of talk about inheritance these days, and partially because of the wealth transfer. This idea that money's in play, are you getting yours? And there is a bit of tension between how to have the best, most comfortable lifestyle for the aged parents versus how much might be left um, as an inheritance for the kids. And I think in most cases where the familial relations are very strong, they're going to say to the parents, "The money's yours, and we want you to dig deep into it to have a comfortable life of ease, and we don't want to scrimp to save extra money." And I think that's a conversation that along those lines is going to happen in very many cases. But not all. And I've talked to enough estate lawyers and heard their stories about like families at war over wills and estates and who's getting what and who feels slighted and who feels that, what the mom and dad's attentions weren't reflected by how the money's getting divided. And I was counting on getting this much and that sort of thing. That's tough. But by and large, I think the baseline understanding should be that inheritance is something we push way off in the future and it will become what may. The money is to be deployed. It's owned by the parents and it is for the parents for their quality of life, and that's where that's the priority of the money. That's the theory I'm working under, and most people I talk to about that, we're fortunate enough to be have positive enough family relationships that they're sharing that view. Parents first.
Yeah. Yeah. Or, what my dad said to me from the time I was 21, "I'm spending it all, you're getting nothing." He was very clear.
A lot of people say that, but my experience is that, especially for the silent generation or the earliest boomers, they talk a big game sometimes about spending all the money, but that's not really what they're good at. I think it's the younger boomers who are the natural spenders, and they're the ones who probably will spend it all. I mean, I think for the silent generation, a lot of them just weren't big spenders in their working lives. And what I've learned is people do not change their financial habits when they retire. And you might have been an avid, strong saver thinking, now I'm going to have all this financial flexibility in retirement, but you're not going to change yourself into a heavy spender to take advantage of all the saving you did. You're going to be frugal.
You say based on your experience is incredible. I can't believe how fortunate we are to have you on this podcast talking about all these things. But that experience is also that of being a caregiver. Your mom is 97 years old, your in-laws are in their 80s. You created this financial checklist for people with aging parents. I'm wondering, Rob, what else have you learned about being a caregiver, about people living into their late 80s and late 90s, and what that means financially?
What I've learned is there's no preparation for this stage of life. I mean, I thought I knew what to expect as I was in my 50s, about what's ahead. And I feel like my generation and I was born in 62, so I'm a late boomer. I feel my peers are just walking around like quietly, almost stunned by this task that we've assumed in being parental caregivers. Like my parents, for the most part, did not live to any great age. There's one exception, my grandfather, but most of them died much younger, and so it wasn't really a thing to retirees looking after retirees. That's a new phenomenon, and I think that my generation feels like we're flying blind, and I'm trying to work hard to make sure that following generations and some of my peers who are just walking up to this stage in life have some guideposts and have some information that they can use to make things easier, to make better decisions quicker.
You've actually coined a phrase that in the financial community, referring to them as the care years. I hadn't
Yeah,
heard
the
that
carry
anywhere else, Rob.
I just made it up 2 days ago. It's, um, it's basically, it's the years when caring for your aged parents, and these are for, let's be honest, this is a fortunate problem to have. Your parents are still with you. A lot of people have lost their parents, and but if you are among the, I think the quite sizable group who have parents in their late 80s and 90s, it's a year when a lot of your bandwidth is going to be used up helping them make their way through everyday life.
And aren't we lucky to do it?
Yes.
From an organizational point of view, what do you recommend to caregivers with their person in terms of, I mean, we have the checklist, but is there like the definites that you're like the list of passwords, people talk about the death book, but I think that the death book should be available before death. You know what I mean?
Yeah, absolutely. I think what you wanna do is sort of like ride shotgun with your parents as they take care of their finances. Um, See what they're doing. You know what, like, and if one thing we haven't talked about is parents who don't want their kids' nose in their business.
Well,
And
because you're a financial
that
guy,
may
not a therapist, and I didn't think I could go there, but if you're going there, go there.
Oh, absolutely. I mean, I think there's gonna be parents who don't trust their kids, who don't feel close enough to their kids, who feel their kids have other agendas, who don't have kids, period. And I think those are complicating factors. And I think, those parents who don't have kids or don't have kids they can work with for whatever reason are going to need to look at things like corporate executors to look after their estate and that sort of. That's expensive, but it is definitely an option. But there are going to be cases where the parent thinks, I'm independent and I've looked after these finances for 50, 60, 70 years, and I don't need your help and I don't want your help. And frankly, I think I know more than you. In those cases, that's really tricky because then you're going to need to step in, but you can't get your foothold. You can't ride shotgun with your parent. You can't say, "So what's your cash flow like? What are your bills? What let's take a look at all your sources of income." And you get this sort of preparatory understanding of their finances. They don't want you to do that because they've got it. But as you've mentioned, and I think a lot of people know, people can go from being fully in control of their finances to disarray in a couple of months, maybe even a day.
We haven't even talked about the implications of the digitization of our banking and what people are expected to do in their 80s and 90s, of the scams that seniors are so vulnerable to, of addiction that can come into people's lives when it comes to gambling, how much of this stuff can happen behind closed doors or behind a computer screen that people do not know. It is so treacherous out there for seniors and their finances. Rob, listen, we've done 2 episodes with you. I'm gonna bark up your tree for a 3rd and probably a 4th because I I I think we're so like-minded in how we talk about stuff. My point of view is as much transparency as emotionally and humanly possible will pay dividends for years and years and years to come.
Yeah, I couldn't agree more. I think my advice based on going into the carriers without any preparation at all is do as much advanced prep as you can, even if it's just conversations about things, because when things get tense, and they probably will at some point, you're going to feel empowered to be really effective in managing things.
Yeah, absolutely. Thank you so much. Rob Carrick's Substack is Rob Carrick, Carrick. We will have it in our
Yes.
show notes. We will also have that cost of aging calculator that you mentioned again in the show notes. And if you haven't already, please make sure you listen to our previous episode with Rob. It is an incredible checklist of what you should go through with your aging parents in terms of a financial checklist. Rob, thanks so much for being on the heart of it all. Incredible information.
Great chat, Terry. Glad to be here.
Well, my goodness, thank you so much to Rob Carrick. He was just the perfect person to walk us through what maybe can be complicated, but once you get into it, things start making more and more sense. It's another reason why I highly recommend you subscribe to his Substack. And while you're subscribing, subscribe to this podcast. Thank you so much to our presenting sponsor, RBC Wealth Management. You can find us wherever you listen to podcasts, and you can also find us on social media, YouTube, Facebook, TikTok, and Instagram. And we love to hear what you want to hear about on the podcast. Slide into our DMs or find our email through our website. Lots of information there. You know who makes it all happen week in and week out, my co-producers, Carrie Hayden and Jess Carroll of 6 of 1 Digital. I am so grateful to them, and I am also grateful to you for listening. Thank you so much. And as always, please take care.